Bad news in the markets today, as the S&P TSX fell a total of 4.6%. Now has officially entered that bear territory, has fallen a total of 20.6% from its record high in February. This isn't good news for the stock market going forward and really puts into question how far stocks will fall. The sectors that are leading this fall are energy, unsurprisingly, followed by materials and healthcare. After yesterday's gains on the S&P 500, it looked like the market might be turning around a bit. But after today's announcements, the S&P 500 dropped a total of 4.9%, almost putting into that bear territory. It is now down 19.2% from its highs in the past month. The Dow had an even worse day, falling a total of 5.86%. This means that from its previous high, it is below that 20% loss mark. It's fallen 20.2% from its high, meaning it is in that bear territory. Overall, this isn't good news for the stock market going forward. The Nasdaq was down 4.7% on the day, making a month loss of a staggering 17.5%, getting close to that bearish territory. In Europe, the FTSE didn't do quite as bad as the other markets, but was still down 1.4%, and over the past 5 days is down about 14%. The Nikkei was down 2.3%, and over the past 5 days was down 8.8%. WTI didn't continue to increase and actually is down on the day, falling 4.7%, making a 5-day loss of 27.7%. Brent also fell 4%. While often you'd expect gold to go up when stocks take quite a hit, gold didn't actually have a very good day and fell 1.4%. And over the past days, it's actually gone down 2.4%. It's currently at 1637. Overall, not a really good look for gold, especially when you consider what's going on. With stocks down on the day, you'd often expect that some of that money would be going into the treasury market, but that really doesn't seem to be happening because overall the rates are pretty steady from yesterday. One of the more notable changes is in the Canada 30-year, as that actually went up a decent amount, as well as the short-term rates going down slightly. Looking at the currency markets, there is no whole lot of difference between yesterday. Big thing though is the Japanese yen did rebound from that fall yesterday and is heading back up. On the losing side, the British pound fell, but that is understandable when you consider that they just cut interest rates. COVID-19 has officially been labeled a pandemic by the World Health Organization, as total cases reach 125,620, with deaths being at 4,605. Overall, a majority of the new cases are coming out of Italy, where they added a total of 2,313 new cases and total deaths of 196. Hopefully their lockdown of the country will improve their case numbers as they'll shrink down. Other places are also seeing pretty big increases, as you can see. Overall, though, the market hasn't been reacting too well to this news as it continues to drop down and enter almost that bearish territory. Big events continue to be canceled as Washington State has announced that any events with more than 1,000 people pretty much needs to be canceled. As you see this happen around most places, it's really not going to go well for tourism and just events as whole, and will probably have a significant impact on the economy in that area. The Bank of England cut their key interest rate by 50 basis points down to that 25 basis point mark. This comes after both US and Canada cut their rates by 50 basis points. They also introduced a new program to try and provide cheap, easy credits, as well as reduce a special buffer to give banks more room to lend to their commercial clients. And they also expect that they may do more going forward. The UK has also pledged a stimulus package of $34 billion. Out of that, they plan to spend £600 billion by 2025, mainly on infrastructure, but are also planning on helping businesses that have been affected, as well as the NHS. Unfortunately, though, they did fail to grow in January, which isn't a good look for the economy, as most of the impact from the virus wouldn't have an effect on January, as most things started to go down in February. The bank also lowered their growth forecast for the UK down to 1.1% for 2020, which is the worst since the financial crisis of 2008. And 2021, they expect only growth of 1.8%. While it seems like the Bank of England think they have most of the things under control, I'm a little skeptical on the actual impact that this stimulus and interest rate cut will have on the economy, as it doesn't seem like it's going to change much, especially when you consider the January growth of 0%. I also am kind of skeptical that this isn't to do with that they want to signal to markets that everything's all right and that they are looking to do the right thing and provide stimulus to combat the effects of loss of economic growth. Italy has also announced a stimulus package of $28.3 billion. Overall, this hasn't gone through, as they expect 50% of this to be approved on Friday. Overall, they're hoping that this will also combat the effects the virus is having on Italy, because currently Italy is pretty much in lockdown as they're really trying to stop the spread. Overall, though, they are worried as the ECB warns of a 2008 style financial crisis in Europe if things go poorly. One of the analysts at JP Morgan, Michael Hansen, also suggested that output there may contract by 7.5% in the first quarter compared to the past 3 months, which isn't a good look for Italy and Europe as a whole. The purpose of this stimulus package is to help with workers that have been temporarily laid off and aren't earning money due to everything being closed down, as well as providing loans to small and medium-sized businesses and compensation for firms with a turnover dropping below 25%. Overall, it seems like a lot of the stimulus package are looking to compensate the people that really couldn't be prepared as well as just affected overall, largely to do with the virus. Canada has also announced a stimulus package with a $1 billion value. In total, they're going to use 500 million to try and help provinces buy equipment and things needed to monitor the virus. 275 million is going into medical research. 100 million is used to pay for enhanced federal surveillance. So basically making sure everything is under control and that they're testing everything correctly. 50 million will be used to help buy needed equipment and products like face masks. 50 million will go to the Public Health Agency of Canada to try and communicate the public on what's actually going on. 50 million will go to help the World Health Organization and other groups. 12 million will be put into a work program. So if you basically aren't able to work as many hours as you normally do because things are being slowed and shut down, it kind of help them out. 7 million will be to go to people in high risk areas. 5 million to go to people with unemployment as they're waiving the 1 week waiting period for unemployment insurance, just to make sure that people who are just getting laid off from businesses closing down right away won't be affected too badly. I thought this article was pretty interesting as a perspective on what's going on with the markets and possibly where they're going to go in the future. So David Costin, who's the chief strategist for US equities at Goldman Sachs, is actually calling for an end of the bull market and expects that we're entering a bear market. He expects that the S&P 500 will go down to 2,450 level by middle of the year. That's about a 15% decline from earlier today and a total of a 28% drop from the peak in February. Overall, he expects earnings will drop by 12% for each quarter over the next 2 quarters. It's an interesting perspective. Hard to say what's actually going to happen, but it seems like it's coming from a kind of a reputable source. And overall, as things continue to escalate with the virus being labeled a pandemic, I could see a lot more of this news coming out, especially when you consider we really don't know what's going to happen going forward, and there's a lot of uncertainty in the market right now. The oil war between Saudi Arabia and Russia continues, with Saudi Arabia now pledging to produce a total of 13 million barrels a day. That's an increase from what reported yesterday of 12.3 billion. Overall, oil is slightly down, but not significantly when you consider where where it was at and where it's been going. Also, the United Arab Emirates plans to pump as much oil as possible next month as well. They plan to provide 4 million barrels a day next month, which is over their capacity of 3.5 million. So probably will use some of their reserves as well. The big drop in the oil prices is having an effect on American markets, as there is an oil and gas meeting between companies happening this week. Overall, Goldman Sachs analyst Angie Sedita has noted that energy companies are probably going to cut their capex by 20% to 50% in 2020, which is pretty significant, but kind of in line with the news certain companies have come out with about how they're cutting capex. An oilfield service company, Schlumberger and Halliburton, are also planning on cutting capex, as they plan to reduce capex by 15 to 30% and by more than 20% respectively. Overall, there's one Goldman Sachs analyst that's expecting oil to hold to that $30 level for the next 6 months. And overall, if it continues to be at that level, I expect that there'll be a lot of capex reduction and more focus on the cost side of the business, as the companies will need to cut down on costs if they want to be able to turn a profit in the future. This leads right into the company news, with two Canadian energy companies announcing that they're cutting capital spending for this year. So, Seven Generations Energy is lowering its capex for this year by 200 million, down to 900 million, which is an 18% drop. They're also planning on lowering drilling operations, and their production will only be 185,000 to 190,000 barrel of oil per day, down from their earlier estimates of 200,000 to 205,000. MEG is also cutting their capital spending plan to 200 million, which is down from 250 million previously, which is a pretty significant drop of 25%. They're also lowering their production guidance for this year, and they only expect 93,000 to 95,000 barrels a day, compared to previous estimates of 94,000 to 97,000. Overall, though, that production cut isn't quite as bad as Seven Generations, but overall it shows you what's going on, especially in the Canadian energy market, that's really struggling with these prices that Saudi Arabia, Russia are bringing out. Moving away from the energy markets into the soft drink markets, PepsiCo has announced that they plan on buying Rockstar Energy drinks for a total of 3.85 billion. This comes off the bat of a lot of soft drink companies having struggles with the waning demand for their products, as there's more options out there, especially with a lot more boutique shops and specialty drinks coming out. Overall, this is kind of an interesting acquisition, but it's hard to say what really it will do for the company going forward unless they can somehow increase the number of people buying Rockstars. But personally, there's better drinks I find than Rockstar out there. Red Bull, Monster, they're sold a lot more and people generally prefer them.